The paper price is flashing 73, but in the real world, the metal is laughing at that number. Because in places where actual bars change hands, Dubai, parts of China, India, people are paying 90, sometimes 100 for the same ounce. That's not a premium, that's a warning flare. And it tells us one thing: the silver market is splitting in two. Paper is one market, physical is another. And if this split keeps widening, the next move won't be a gentle climb, it'll be a snap. Welcome back. No fluff today. We're here to read the real signal and protect our future. If you want straight, risk-managed silver breakdowns like this, hit subscribe now. Short button, long benefit. Now watch this. When you hear silver is at 73, that sentence hides a trap. Fact: 73 is a paper reference price. Fact: most people cannot buy meaningful physical size at 73 because fees, taxes, fabrication, and scarcity sit on top of it. Interpretation: the shortage isn't coming. It's already here, just unevenly distributed. And the uneven part is what creates chaos. Because shortages don't announce themselves with sirens. They show up as sold out, call for quote, and 2-week delay. They show up as street prices that ignore the screen. So let's pin down what's actually happening. In several physical hubs, silver is trading like a different commodity. Dubai dealers are reportedly quoting numbers that sit far above spot. In China, even when futures look tame, a value-added tax and tight logistics can push the delivered price into a different league. In India, layers of tax and local demand add another lift. Turkey and Pakistan? Import costs and currency pressure can turn every ounce into a luxury item. Different countries, same pattern. The screen says one thing, your wallet hears another. And here's the uncomfortable question. If paper can say 73 while the street says 95, what happens when paper says 60? Do we really think the street politely follows it down, or does the street simply stop selling? This is where the story gets serious, because silver is not a boutique collectible anymore. Silver is a workhorse input. Solar, electronics, power grids, 5G, EVs, defense tech, medical applications. It's everywhere. And we don't get to pause industrial demand just because a chart looks heavy. That demand is the engine, and it's been running hot. Now, I'm not asking you to accept any headline blindly. This is educational. We manage risk. But we can still reason like adults. Silver supply doesn't behave like a meme stock. You can't summon new ounces with a tweet. Mining is slow. Permits are slow. Grades are declining in many mature districts. CapEx is expensive. And even when a project is real, it doesn't turn into production overnight. The hard truth: when you need more metal next year, a mine that opens in 10 years doesn't help. So if demand is leaning forward and supply is dragging its feet, the pressure builds like a dam. And dams don't leak politely. They fail suddenly. Now let's talk about the 5-year deficit idea that keeps getting tossed around. You've heard numbers, you've heard charts, but the key is simpler. If we use more than we replace, inventories shrink. If inventories shrink, the market becomes jumpy. If the market becomes jumpy, premiums become the real price discovery. That's the mechanism, not vibes, mechanics. And once premiums become the real signal, the paper price becomes entertainment. A casino scoreboard. Here's the next clue. When physical metal is tight, it doesn't just get expensive. It moves. It migrates. It flows from weak hands to desperate hands. From nice to have to must have. From west to east, if the bid is stronger there. Because global arbitrage is ruthless. If someone can buy in one region and sell in another for a clean spread, they will. And that spread is a magnet that pulls bars across oceans. So while you're watching a spot chart, actual metal is boarding planes. And you don't need conspiracy to explain it. You only need incentives. Now add another layer: policy. When a major refining and manufacturing hub tightens export licensing, even a little, it acts like a choke point. Maybe the restriction is targeted, maybe it's bureaucratic, but the effect is the same. Uncertainty increases, lead times stretch, and buyers overorder just in case. That behavior alone can create shortages, because the real enemy isn't demand, it's panic demand. And panic demand is born from uncertainty. Ask yourself this: if you run a factory that cannot miss a delivery date, do you wait until the shelves are empty? Or do you lock supply early, even if you pay up? Exactly. That's why we keep hearing stories about industrial players approaching mines. Not to speculate, to secure, to reserve, to control a pipeline. And once the industrial buyer turns into a long-term contract buyer, the spot market loses supply. The loose float shrinks. And when the float shrinks, price reacts faster. This is the part most people miss. They think the price is set by the market. But which market? The market of paper promises, or the market of metal that can be delivered, melted, manufactured, and used? In a stress scenario, the second market wins, because physics doesn't take IOUs. Now let's zoom in on the tax effect, because it's not just annoying, it's structural. If a country adds a 13% VAT to silver, that isn't a small fee, that's a wall. And walls change behavior. They change where metal goes. They change who buys. They change how much inventory a business must hold. They also create a weird psychological trick. People see spot down and assume good deal. But if the VAT keeps your out-the-door price high, spot down doesn't help you. It helps a spreadsheet, not your stack. And if taxes are rising while supply is tight, the local physical price can stay stubbornly high even as paper drops. That is the decoupling. That is the split. Now, let's pause here, because this is where most people make the mistake. They treat premiums like temporary noise. They assume it'll normalize. But what if it doesn't? What if premiums are the new normal because the system is running a structural deficit? Then the correct question isn't, when will spot catch up? The correct question is, when will people stop believing spot? And when the belief breaks, the system reprices violently. Because paper prices are anchored by confidence, physical prices are anchored by scarcity. Confidence can evaporate in a weekend. Scarcity cannot. So what are the real takeaways for us, right now, without turning this into a fantasy? First, we need to separate signal from noise. Signal: persistent high physical premiums across multiple regions. Noise: daily paper volatility that doesn't change delivery conditions. Second, we need to respect the supply timeline. If new mine supply takes years, then a tight market can stay tight longer than you expect. Third, we need to watch the east-west flow. If metal keeps moving toward the stronger bid, Western inventories don't magically refill. Fourth, we need to understand industrial behavior. When big buyers start locking contracts, they remove optionality from the market. And fifth, we need to manage our own plan with discipline, not fear. We're not gambling, we're measuring. Now here's a contradiction that should bother you. People will say, if there's a shortage, why isn't the price exploding already? Because paper can absorb pressure, until it can't. Paper markets can create the illusion of abundance by expanding contracts, but physical markets can't expand atoms. So the paper system can delay the recognition. It can smooth it. It can confuse it. But it cannot defeat it. All it can do is postpone the moment when everyone tries to touch the same ounce at the same time. And that moment is what moves markets. The real risk isn't silver goes down $5. The real risk is you can't get it when you want it, or you can only get it at a brutal premium. That's the risk that matters to families building long-term protection. So what do we do with this? We don't do hype, we do process. Start with your objective. If you're stacking for insurance, you care about ownership, liquidity, and recognizable product. You don't need novelty, you need ounces. If you're trading, you care about timing, spreads, and exit routes. Different game. Don't mix them. And if you're investing in the supply side, miners, refiners, royalty plays, then you care about jurisdiction, balance sheets, and whether the company actually benefits from higher prices. Because not every miner is a clean proxy. Some are hedged. Some have political risk. Some are capital traps. So we do homework. And we size positions like adults. Now, since we're talking physical, let's be blunt. In a real squeeze, the market doesn't reward fancy. It rewards weight. Industrial buyers don't care about artwork. They care about feedstock. So if we're building a stack, we focus on low-friction items. Widely recognized bullion, bars, and simple coins that are easy to verify and sell. We reduce the premium we pay today so we don't need a miracle tomorrow, and we keep a calm mind. Because volatility is a weapon. When paper prices whip around, the goal is to induce motion sickness. They want you to sell the bottom and buy the top. They want you to confuse price with value. But if the physical market is tight, then paper dips can become opportunities. Only if you can actually source metal at a rational all-in price. That's the key phrase. All in, not spot, all in. Now I want to talk about the strategic metal angle without getting dramatic. Silver has properties that are hard to replace: conductivity, reflectivity, antimicrobial behavior. Substitutes exist on paper. In engineering, substitutes often mean performance loss, efficiency loss, or higher maintenance. So when someone says, they'll just use copper, ask, at what cost? At what efficiency hit? At what lifespan reduction? If the substitute makes the product worse, the substitute is not a substitute. It's a compromise. And industries don't love compromises when margins are tight. That's why demand can stay sticky, not because people like silver, because systems need it. Now here's the part that should make you sit up. If the world is burning through inventories, and the East is paying up, and taxes are raising the delivered price, and industry is locking contracts, then paper is not the scoreboard that matters. Delivery is. Availability is. Lead time is. And those things don't show up in a candlestick. They show up in your dealer's voice when you ask, "How much can I get today?" Now let's open a loop. There's one place where this split becomes obvious fast. Vault inventories tied to futures delivery. When those inventories drain, the system's flexibility disappears. When flexibility disappears, one surprise demand spike can cause a scramble, and scrambles create policy responses. So the next phase isn't just higher prices. The next phase can be allocation, limits, and priority customers. That's when the public finds out the hard way that liquidity was an assumption. And once that happens, the behavior flips. People stop selling. They start hoarding. And hoarding turns tightness into a squeeze. So here's what I want from you in the comments, because we build this together. If paper spot dipped hard tomorrow, would you try to buy more physical? Or would you wait, hoping premiums collapse? And second question, do you think the real stress point shows up first in retail coins or in industrial bars? Drop your answer. 2 lines, no essays. Now, let's be practical. If you're preparing, you don't need to be all in. You need to be consistent. You need a plan, a schedule, a target. And you need to avoid the trap of chasing headlines. Headlines are designed to whip your emotions. We don't trade emotions, we trade probabilities. And the probability set right now is simple. Structural tightness can persist longer than the average person can stay patient. That's why most people miss commodity moves. They get bored. Then, when the move finally hits, they arrive late and pay the panic premium. We want to be early, calm, and measured. Now let's talk about something that sounds small but isn't. Fabrication bottlenecks. Even if raw silver exists, turning it into retail products takes capacity. Mints have limits. Refiners have limits. Shipping has limits. When demand surges, these bottlenecks magnify premiums. So even if spot behaves, your buy price can still rise. That's another way physical decouples. And when people finally notice, they usually notice at the worst time, when everything is delayed. This is why we don't wait for perfect confirmation. Perfect confirmation is expensive. Now, a quick disclaimer again, because we stay credible. This is education, not financial advice. We manage risk. We avoid leverage we can't control. And we don't let any single narrative become a religion. But we do respect the data in front of us. Persistent premiums, persistent deficits, and tightening policy signals. Now here's your retention beat, because you need to see the chessboard. The price you see is not just a number. It's a battleground between 2 incentives. Paper wants stability. Paper wants confidence. Paper wants you to believe supply is endless. Physical wants truth. Physical wants delivery. Physical wants the atom. When these 2 incentives collide, one of them yields, and it's never physics. So where does this go next? If tightness continues into 2026, we likely see more offtake deals, more quiet industrial securing, more eastward pull, and more pressure on retail availability. Spot might spike, spot might crash, but physical will be governed by 2 blunt forces, scarcity and policy, and those forces don't care about your chart pattern. And don't sleep on the recycling myth. People love saying, we'll just recycle it. Fact, silver is dispersed in thin layers across billions of devices. Interpretation, recovery is slower and more expensive than most expect, especially in the short window that matters. Even when recycling works, the metal comes back late. A phone gets recycled in years. A grid component lasts decades. A battery pack doesn't come back next quarter. So shortages can deepen before recycling shows up as supply. Now ask yourself, if demand keeps pulling forward and supply can't respond fast, where will the stress show first? In premiums? In vaults? Or in the headlines they're avoiding? Which brings us to the uncomfortable conclusion. If you wait for the paper market to confirm the shortage, you may be the last person in line. And the last person in line pays the highest premium. So our job is not to predict the next tick. Our job is to build resilience. Ounces in hand, cash reserves intact, no panic, no ego, process. If you're with us, tap subscribe, quick and clean, because the next phase of this story will move fast. And I'll end with a warning, not a summary. There is a moment in every tight commodity market when the public wakes up and says, wait, why can't I buy it? When that moment hits silver, the screen price will be the least interesting thing in the room, because the real price will be whatever someone is willing to pay to avoid shutting a factory down. And once industry starts bidding against the public, we don't get a second chance to buy calmly. So keep your eyes on availability, not headlines. Keep your plan tight, and watch what happens when the next policy headline drops. Because the next restriction won't just move the price, it'll move the metal.